Honourable Minister, thank you so much for finding the time to meet with FBN Capital, and we have a few questions for you in your capacity as Finance Minister. But first of all, perhaps you could just outline briefly your fiscal strategy.
Well, thank you very much. We have come into office just over about 18 months now. But our philosophy around the Nigerian economy is to move it from a consumption-driven economy to an investment-driven economy. And for years we have been just an extractive economy. We pump the oil and we basically export it crude and import everything that we need. Now with the fall in the oil price, that's exposed the vulnerabilities of that strategy, and we need to now reposition the Nigerian economy to become investment-driven. Changing the spend pattern from what we inherited, which was just 10% capital and 90% recurrent, to 30-70 as a first step, but then around that wanting to crowd in private investment in infrastructure. Infrastructure is critical because if you look at all the problems in the Nigerian economy, it comes back down to infrastructure. That's what stops us from being competitive. That's really what drives inflation, because our inflation is imported. That's what's driven our import dependency, and that's what stopped other sectors of the economy becoming productive. So we believe that if we can focus on our infrastructure, it's a big infrastructure deficit, but if we can begin to attack that infrastructure deficit, we can make the economy productive. So that is it in a nutshell. And now to do that, there are a number of fiscal initiatives we have to drive. One, of course, is to increase our revenues. The other, of course, is to reduce our recurrent expenditure, to create that headroom for the capital expenditure that's needed to really drive the economy. And that's really what we're working on.
Well, thanks for that. Actually, the first two questions feed directly into what you just told us. The first one on tax revenue to GDP ratio, probably halfway it should be. How quickly can the federal government reach an appropriate level?
We've set ourselves a target. It's currently 5% of GDP, which, as you've said, is very, very low. It's lower than all our peer group, and it's an obvious area where we can improve. The FIRS have started on a very aggressive policy of drawing more people into the tax net. We have set ourselves a target to increase it from 5% of GDP to 7% of GDP within 3 years and 10% of GDP within 5 years. And we think this is attainable. A number of strategies we'll be using, as I've said. We're driving people into the tax net using technology. We've already been able to register over 700,000 companies that had not paid any tax at all in the last 1 year. Brought them into the tax net. We're using technology, we're using data to identify companies and persons who are eligible to pay tax and are not doing so. We've recently put together a small tax amnesty to the end of the year where we're waiving penalties and interest to encourage people to come forward. And we're confident that those strategies will work. We'll make it more and more difficult for people to do business if they're not tax compliant. For example, here in the Ministry of Finance, it's impossible to get a payment out unless we check your tax status. So it's little data points. Wherever we're getting data on who's doing business in Nigeria, we're driving them into the tax net. And we think that's a sustainable revenues. But we're also bringing people onto our integrated payroll and personnel system, IPIS, which is a biometric payroll system. So that initiative is also going on. Then we're constantly checking against BVN numbers, looking for duplicates and eliminating people from the payroll. That's an ongoing exercise. We think there's still a long way to go. We haven't brought on some of the big payrolls like the military. They're still out. The Navy are still out. The Air Force are still out. And those are the areas, the military and the paramilitary are typically the areas of the payroll where we have the most error. So we still think that there is significant savings to be made, and we don't see ourselves having to force redundancy.
Could we have an update, please, Minister, on capital releases within the 2016 budget?
All the big spending ministries have had significant amounts of their capital allocation released to them. And we're seeing the impact already with contractors moving back to site. I think the first release, we saw certain hesitation from the contractors. Some of them hadn't been paid for 4 years, so naturally their sense was, are we sure this is going to be sustained? And the tendency was to sit on the money. But with the second release and subsequent releases, we've seen a lot more activity from our contractors moving back to site as part of our efforts to stimulate the economy.
If the price is right and the coverage was right, would it not be a temptation to raise more than $1 billion from the forthcoming Eurobond issue?
We already have commitments that are at least 500 million of that 1 billion. So we have no fears of not hitting the 1 billion. The question is, as you said, if the price is right, might we, as part of a prudent debt management strategy, consider taking a bit more? Yes, we have that flexibility in our medium-term borrowing strategy. And part of our plan, actually, as part of our debt management, was to refinance some of our Naira obligations into external, to take advantage of cheaper interest rates and to take longer tenures. So we might look at that option. But at the moment, I'm just focused on doing the one, which is what.
No, of course. But the Naira obligations you just mentioned. Can we expect to see the proposed deficit financing from the World Bank and the African Development Bank in place shortly?
Well, the AFDB, we're further along with them than the World Bank, and that's a deliberate scheduling issue because with the Forex adjustment, of course, the 4.5 limit became much less in terms of what we could borrow and take externally. And we already had commitments with China Exim with the rail project. So what we've done is pushed part of the World Bank funding into next year's budget and take the ADB this year. We're on track. We finished a negotiation with them this is October, so this month, and we're hopeful that before the end of the year we'll complete that transaction. And then, of course, as you know, the Eurobond is the commercial.
Is the commercial side. Okay. Does the request to the Assembly for $30 billion in external financing for the next 3 years cover all the likely needs over the period?
I think it will. I mean, this is mainly concessional borrowing. And of course, we had said from the beginning, in terms of our debt strategy, we were going to take the cheapest money, the lowest cost money first before we move up the food chain, so to speak, to the Eurobonds and the like. So we're confident, and this is money that is project tied, and of course you recognise it also includes subnational borrowing, because the external borrowing plan is for the entire country.
Could we have an update, please, Minister, on the non-debt financing element of covering the deficit for this year? So we're talking about the recoveries principally, and we're talking about asset sale. And talking of asset sales, perhaps some thoughts on the domestic debate on the issue, which has been initiated, although not by the federal government.
Well, the recoveries were always a part of our strategy. We've gone about it in a very systematic manner, but as you know, recoveries are very slow. So, you know, we're still battling with the Swiss on a Abacha loop that's been with them for 20 years. We have, you know, there's a long lead time. You have to go through a judicial process. And of course, there are usually people who are holding these funds, straw men for want of a better description, who are holding these funds, who will then go to court to try and stop you from getting access to them. We've had a lot more cooperation with the President because of his goodwill from the international from our international partners and from other countries in terms of remitting these funds. And so far we've been able to secure agreements with the Swiss. There's some money in America which we're chasing. But all this money, as I say, is money that was taken 15 years ago. The more recent money is taking a little longer and again tied up in legal process, but we're very confident that we'll get it. We've recovered most of what we've recovered has been recovered locally through the EFCC and through the various investigative agencies, and quite a few people have surrendered assets as part of the investigative process. So I think that, of course, when you're looking at a situation as that, you have to look at all options and you have to assess those options carefully. But I don't think any decision has been taken, and I don't think if such a decision were to be taken, it'd be taken in a hurry on the front pages of newspapers. You've got to have a strategy around these things. So far, my financing plans are around what I've announced, increasing our revenues, borrowing a little more, and tightening up, doing some sort of fiscal tightening to create headroom for capital investment.
So I mean, basically the fire sale, whatever you want to call it, right, has come to discussion long after the drafting of the medium-term framework. Yes. So it's not included at all.
Yeah. Right. Well, as I say, I think it took on a life of its own, and I'm not sure that it was government-driven. I think government found itself reactive, but I'm not, I mean, of course, if you have a fiscal deficit, you've got to look at all your options, and if there are, you look at the cost-benefit analysis, but you've got to look at the value of assets as well. What are the type of assets you have left? If you have oil assets and oil prices depressed, then it may not be a good time to sell oil assets. So I think it's
Can you see further debt relief measures ahead, or are they necessary? Really, is the question.
Our approach to state governments has been to put them, as well as ourselves, on a path of fiscal sustainability. And what we put together was the 21-point fiscal sustainability plan, which was conditional. And that was what we tied the relief to. And that plan really required state governments to tighten up on their recurrent expenditure, introduce efficiency units just as we have, do biometric of their payroll. In other words, to do the necessary fiscal housekeeping to put themselves in better shape. And the other reform was widening the definition of internally generated revenue, because traditionally when states were speaking about internally generated revenue, there were just two sources. It was taxes, it was the Lagos model, it was taxes and land fees. Now, that's fine if you have a private sector, but for most of the 36 states, a large majority, there is no private sector, so they have to start to think differently. And we've started to see that, and that's been very exciting. One of the states, Kemi, his IGR is I Grow Rice. He's gone out and he's become the biggest rice dealer in his state. He has gotten his smallholder farmers growing rice. He's the buyer, he's the bagger, he's the seller. So it's changed the definition of what revenue is, and I think that's very important. So we've said to the states, and we've interfaced with them, we built up these fiscal sustainability plans, some they sign up to and put targets on and say this is what we're going to do. And that puts them in stronger fiscal health. So we don't see at this stage a need for any further intervention. We've had a tough month this last month because the 3-month lag between action and revenue in terms of the Niger Delta disruptions have just fed into the FAC account. So we did have a tough month last month and probably will have another tough one next month. But we think that most of the states now are on a fiscal sustainability, a fiscally sustainable path. They understand what their costs, recurrent costs are. They understand what their revenue projection is. And they're managing their finances a lot tighter as a result. So no, I don't anticipate.
Okay. And finally, Minister, passage of the budget. So, I mean, most people say that one of the pillars for the economy to emerge out of recession would be capital spending from the government side. Now, perhaps you could give some reassurances that we can expect a more rapid passage of the budget 2017 and a smoother process. Thank you.
Yes, the Minister of Budget and Planning is working very hard, and his team are working very hard on ensuring that we get back onto the right timetable for the budget. They have started that work. They're at a very advanced stage, finalising numbers, and we're quite confident that we'll get back on track in terms of getting the budget released and approved on time. And of course, as you've said, that's an important pillar in our programme to really stimulate and reposition this economy. So we're confident that we'll get back on track. Last year was a very unusual year. We came in late, we came in towards the end of the year. There were challenges, but I think a lot of lessons have been learned, and I think this year's process will be a lot smoother.
Well, Minister, thank you so much for your time.
Thank you.